We begin by reviewing the balance sheet. First, the usefulness of the statement of financial position. 1. It provides information about an entity's assets, liabilities, and equity. 2. Evaluation of liquidity, solvency, and financial flexibility. 3. Aids in assessing risk and predicting future cash flows. What are the limitations of the statement of financial position? 1. Fair value is not reflected, since most assets and liabilities are reported at historical cost. 2. Estimates and judgments must be utilized. A. In determining the collectibility of receivables. B. In assessing the salability of inventory. Circa in determining the useful lives of long-term assets. 3. The statement omits many items that are of financial value to the business. A. Assets such as the value of a company's human resources and research and development are not reported because a company cannot record them objectively. B. Some liabilities or commitments such as leases and certain contractual arrangements are reported in an off-balance sheet manner. Now we will review the major subclassifications in the statement of financial position. We begin with non-current assets. 1. Long-term investments. Management intent here is to hold these investments for an extended period of time. They include A. Investments in securities, bonds, common stock, long-term notes. B. Investments in tangible assets not currently used in operations, land held for speculation. Circa investments set aside in special funds, sinking funds, pension funds, plant expansion funds. D. Investments in non-consolidated subsidiaries or associated companies. 2. Property, plant, and equipment. These include tangible long-lived assets such as land, buildings, machinery, furniture, and, wasting resources, timberland, minerals, used in operations. Remember that A. Most assets in this category are either depreciable, e.g., buildings, or consumable, e.g., minerals. Land is not depreciated. However, land improvements are depreciated. B. Long-lived costly tools are usually included in this category. In practice, small tools are frequently expensed when purchased or are included as inventoriable current assets. C. The basis of valuation, e.g., historical cost or fair value, any liens against the property, and accumulated depreciation or depletion must be disclosed. D. In practice, a detailed classification of property, plant, and equipment is disclosed in a supplementary schedule rather than on the face of the statement of financial position. Then there are intangible assets, which are resources that lack physical substance. A. Examples include patents, franchises, copyrights, goodwill, trademarks, trade names, and customer lists. B. Usually, a high degree of uncertainty exists regarding the realizability of future benefits. Circa limited life intangible assets are amortized over their useful lives and reported net of the accumulated amortization. D. Indefinite life intangible assets, such as goodwill, are not amortized but are assessed periodically for impairment. E. Expenditures for intangible assets, such as most R&D and internally developed goodwill, are not capitalized but are expensed as incurred. 4. Next there are other assets. A special classification for unusual items that cannot be included in one of the other asset categories. A. Examples include long-term prepaid expenses, non-current receivables, and prepaid pension cost. B. Some items included in this category should be classified elsewhere. Then there are current assets. A. Which are resources that are expected to be turned into cash, sold, or consumed within a year or the operating cycle, whichever is longer. B. There exist some conceptual weaknesses in the classification of current assets. 1. Prepaid expenses will neither be turned into cash nor used to pay a current liability. 2. Consumption of fixed assets during the current period. Conceptually, the current depreciation and amortization charges should be classified as current assets. Circa items included in the current asset section are 1. Inventories. The basis of valuation, e.g., lower of cost or net realizable value. Cost flow assumption, e.g., FIFO or average cost. and stage of completion of manufactured inventories should be disclosed. 2. Receivables, which are the amounts of expected uncollectible accounts, non-trade receivables, and accounts pledged or discounted must be disclosed. 3. Prepaid expenses, which are expenses prepaid beyond the current operating cycle, are reported in the Other Asset section. 4. Short-term investments. A company should report trading securities, whether debt or equity, as current assets. 5. Cash. Any cash restricted for purposes other than current obligations is excluded from current assets. Cash equivalents are short-term highly liquid instruments that mature within 3 months or less. Next we look at equity. A. Share capital. The par or stated value of shares issued. It includes ordinary shares and preference shares. B. Share premium. The excessive amounts paid in over the par or stated value. Circa retained earnings. The corporation's undistributed earnings. It may be divided between the unappropriated and restricted amounts. D. Accumulated other comprehensive income, also referred to as reserves or other reserves, includes such items as unrealized gains and losses on available for sale securities and unrealized gains and losses on certain derivative transactions. E. Treasury shares. Represent the amount of ordinary share capital repurchased. F. Non-controlling interest, minority interest. A portion of the equity of subsidiaries not owned by the reporting company. 7. Non-current liabilities. A. Definition. Obligations that a company does not reasonably expect to liquidate within the longer of 1 year or one normal operating cycle. B. There are 3 types. 1. Obligations arising from specific financing situations where additional assets are acquired. Issuance of bonds, long-term lease obligations, long-term notes payable. 2. Obligations arising from ordinary operations of the company such as pension obligations and deferred income tax liabilities. 3. Obligations that depend on the occurrence or non-occurrence of one or more future events to confirm the amount payable, or the payee, or the date payable, e.g., service or product warranties. Circa any premium or discount on bonds payable is disclosed separately as an addition to or subtraction from the bonds. D. The currently maturing portion of long-term debt is classified as a current liability. 8. Current liabilities. A. Definition. Obligations that the company reasonably expects to settle within its normal operating cycle or 1 year, whichever is longer. B. Examples. 1. Payables resulting from the acquisition of goods and services. Accounts payable, salaries and wages payable, income taxes payable. 2. Collections received in advance for the delivery of goods or performance of services. Unearned rent revenue, unearned subscription revenue. 3. Other liabilities whose liquidation will take place within the operating cycle or 1 year, such as the portion of bonds to be paid in the current period. Short-term obligations arising from purchase of equipment. Circa generally, notes payable, accounts payable, or short-term debt are listed first, and income taxes payable or other current liabilities are listed last. Now let us examine the statement of cash flows. The purpose of the statement, A, is to provide information about the cash receipts and cash payments of an entity during a period. B. To achieve this, the statement reports on the operating, investing, and financing activities of the business. The statement is useful because it provides answers to the following important questions. A. Where did the cash come from? B. What was cash used for? Circa what was the change in the cash balance? Now let us look at the different classifications of cash flows. A. Operating activities. The cash flows connected with the determination of net income. B. Investing activities. The cash flows connected with purchasing and selling investments in property, plant and equipment and making and collecting loans. Circa financing activities. The cash flows connected with borrowing and repaying amounts borrowed, selling stock, and paying cash dividends. Next, consider the significant non-cash transactions. A. All significant financing and investing activities must be disclosed in a separate note to the financial statements, even though cash is not affected. B. Examples of transactions that must be disclosed. 1. Conversion of bonds to common stock. 2. Acquisition of property through issuance of stock or through the exchange for other property.